Welcome everyone to today's webinar. I am Chris McCauley, Benefits Attorney with ProBenefits. Today's webinar is part of our 2015 ProBenefits Client Webinar Series. And today's discussion is about ownership eligibility for tax benefit plans. As always, everyone that registered here in attendance will receive a copy of the slides and recording after today's presentation. And also, if you have any questions, feel free to use the question box on the right side on the control panel to submit those questions, and I'll try to get to those questions at the end of today's presentation. Today's webinar is a mini webinar, 15 minutes, so because of that, let's jump straight into the information. And rather than starting directly with specific plans, let's just look at a quick overview, and that is that tax benefit plans are generally designed only to permit the participation of employees, and self-employed individuals or owners are generally not considered employees for purposes of these plans. Today, when we're discussing owners, what I'm talking about is owners of a sole proprietorship, partners in a partnership, LLC members, more than 2% S-Corp shareholders. Generally, that's the group of individuals that we're discussing today. C-Corp shareholders generally are excluded from today's discussion because for the most part they are considered employees and are eligible for tax-free benefits. Although as we will get to, discrimination testing may be a concern for these C-Corp shareholders. But just looking at the distinction between the owners and the C-Corp shareholders and why there is a distinction here, I think the main distinction for why C-Corp shareholders can participate is because of the taxation of the organization. C corporations are taxed at both the corporation and the individual level, and that is distinct from the owners of sole proprietorships and partnerships that are only taxed at the individual level. So taxation sort of passes through the corporate level. So a lot of these entities are established by state law. So if your state has a different type of entity that maybe doesn't exactly fit into one of these two groups, in order to determine whether they are more like owners or whether they are more like C-Corp shareholders, I think what you want to do is look at how is the organization taxed. And so if it's only taxed at the individual level, chances are they would be considered owners. And so now let's jump straight into the specific plans. Let's first start with our general Section 125 Flex Plan eligibility. For those particular plans, owners are ineligible to participate in the 125 plan, either for pre-taxing premiums or the flexible spending accounts, FSAs. So owners are able to participate in the benefits offered under the 125 plan. They can be covered by the group health coverage, the group dental plan. They are just ineligible to pay for their premiums pre-tax. So their premiums must be post-tax. The owners potentially could be covered by eligible individuals if they have a family member that is eligible for the 125 plan and elects family coverage, and the owner is covered. Potentially they could be covered, but they themselves are not eligible to participate in the plan. In terms of becoming an owner mid-year, if an individual becomes a partner mid-year, then he or she is ineligible prospectively. So, I'm sorry, go back to the last slide. So, once a partner becomes And once an individual becomes a partner and they are an owner, they are ineligible going forward. So they don't have to make any corrections if they have been pre-taxing or premiums or part of the 125 plan retroactively. That's distinct from owners of S-Corps. So S-Corp shareholders that become owners mid-year, they are actually ineligible retroactive to the beginning of the current plan year. And so if an employer knows that an individual is going to become an S-Corp owner during the middle of the plan year, they might want to exclude that S-Corp owner from the start of the 125 plan year. That's 125 plans. Now let's talk briefly about HRAs. And again, owners are ineligible to participate, certainly tax-free in the HRA. Certain specially designed HRAs may allow reimbursements to an owner and dependents on a taxable basis. This isn't expressly permitted in the rules, but it is sort of implied. So some employers allow owners to receive HRA reimbursements and tax the owners on the value of that coverage. Basically what that looks like is a premium is assigned to the HRA, and that premium is then imputed to the income of the owner, and they are taxed on that. They are then taxed on that coverage. It seems like I might be having some issues with the slides, so I'm going to briefly. I'm sorry, we're back up, and now it's on the HRA slide. And so again, as I was saying, it's not expressly permitted by the rules, but some plans do permit owners to participate in the HRA on a taxable basis. Now moving on to HSA accounts and HSA eligibility, health savings accounts. Generally, owners are eligible to participate in HSA accounts, and that's assuming that they satisfy the general HSA rules. They have high deductible health coverage. They have no disqualifying coverage, such as other FSA or HSA coverage. So assuming they satisfy the general HSA rules, owners are eligible to participate in HSA accounts. And that's really, the reason they're able to do that is HSAs are really individual tax savings vehicles. They're distinct from employer-sponsored plans. So since they're looked at as an individual plan rather than an employer-sponsored plan, owners are generally eligible to participate. Of course, owners are ineligible to make pre-tax contributions through the 125 plan. So some employees, if their 125 plan allows, can make contributions through a 125 plan. The owners themselves cannot do that. Essentially, what the owners have to do is take their previously taxed income, contribute it to the HSA account, and then take a deduction, a line item deduction, when they're filing their taxes on Form 1040. Another topic I want to talk about is ownership attribution. So basically, this topic or this concept is the fact that an individual might actually not be an owner, but they might be considered an owner if they have a certain relationship to an owner. So essentially a person's ownership is assigned to certain family members so that the family members potentially are ineligible to participate. And this is really relevant for two particular issues. The first is eligibility, and the second, which we will talk about on the next slide, is discrimination testing. But first, let's talk about attribution and eligibility for 125 plans or HRAs. And again, generally, potentially an owner's share of ownership may be assigned to family members in some cases, making those family members ineligible even if they are employees of the company. And so the particular relationships are a spouse of an owner, a parent, a child, or a grandchild of the owner. And so let's talk specifically about the different entities because there's really a distinction here. The first is for S-Corps. For S-Corps, attribution does apply in terms of eligibility for 125 plans or HRA plans. So what that means is that those particular family members, a spouse, a parent, child, or a grandparent, may not participate in the 125 plan even if they are an employee and generally would be eligible, but since they are a relative of the owner, they are ineligible to participate because the owner's ownership interest gets attributed to the employee. Now distinguish that from a sole proprietorship or a partnership in which there is actually no attribution in this case. Family members may participate in the 125 plan, so a spouse of an owner may participate in the 125 plan, assuming that they are a bona fide employee. Essentially, they actually are an employee that meets eligibility requirements in terms of the number of hours they work and are not just a nominal employee. So they're a bona fide employee and not an owner. Assuming that's the case, if the entity is a sole proprietorship or a partnership, there's no attribution, and those particular family members still may participate. And then another issue is discrimination testing. So just because C Corp owners or certain family members may participate in tax benefit plans, as we've discussed, there could be some issues in terms of the harm they cause to the discrimination testing. And so, and attribution, as we talked about, applies to eligibility, but it also applies to discrimination testing. And so for C Corp owners and certainly certain family members, although they may be able to participate in the plan, they might cause harm because of attribution to the testing. So common tests that apply to attribution to all entities, including sole proprietorships and partnerships, are the Section 125 Key Employee Test, the self-funded non-discrimination tests, and also the dependent care FSA 55% test. So I'll just talk about an example here that sort of illustrates the issue. So an employee spouse of a sole proprietorship, we talked about on the last slide that attribution does not apply in a sole proprietorship situation as it applies to eligibility. So the employee spouse is permitted to participate in the 125 plan. However, attribution does apply for discrimination testing. And so the particular spouse in this case may be considered a key employee for testing purposes. So key employees for the 25% test include a more than 5% owner or a more than 1% owner with compensation in excess of $150,000. Because attribution applies for discrimination testing, this particular spouse is considered to be an owner as it applies to this 125 key employee test. So they are eligible to participate in the plan, but they are part of the prohibited group for discrimination testing purposes. And so what that means is they are part of the plan, but they can potentially cause the plan to fail discrimination testing. And this is really an issue for really small employers that may be a sole proprietorship that has an owner and 3 employees, and 1 employee is the spouse of the owner. and the spouse is eligible to participate, but because there may be only one or two other participants in the plan, the spouse could cause the plan to fail discrimination testing. Finally, one last issue I want to talk about is premium reimbursement for S-Corp owners. Our last mini webinar a couple weeks ago was all about the individual premium reimbursement topic, and that's a hot topic in the news today, but this is just one aspect for S-Corp owners. A common plan design is for employers to pay individual medical premiums for S-Corp owners on a taxable basis. Generally, that would now be prohibited under the ACA market reform rules, but the recent notice 2015-17 provides transition relief specifically for S-Corp owners. So penalties for reimbursing S-Corp owners' individual premiums will not be assessed until further guidance on this issue. So essentially enforcement has been delayed for S-Corp owners on this issue. That essentially wraps up today's discussion. Sorry for the technical difficulties earlier. I have a few additional resources if necessary. The first is ProBenefits has an owner eligibility summary chart, and that's available on request. It basically summarizes what we talked about today regarding the various entities and the specific plans. Also, IRS Notice 2015-17 is also available at the website provided here. And that basically wraps up today's presentation. I will stick around to answer some of the questions by writing that have been submitted, and feel free to submit any more questions here during the next few minutes. Thanks for attending, and have a good day.